Your RSUs vested. Taxes came out of every single vest, and you still owe the IRS $18,000 in April. Nothing went wrong. It's how the system is designed. Your employer under-withheld on purpose by IRS default, and nobody at HR is going to call and explain it. For every $200,000 in RSU vest this year, if you are in the 35% bracket, you're quietly short about $26,000 in withheld tax. That is the check you'll write in April unless you close the gap now. I'm Hazel Secco, CFP, and a fee-only fiduciary at Aligned Financial Solutions. In this video, I'll show you the 2 moves that defuse this trap before it detonates, and how to know exactly what you're already on the hook for. The gap in 1 minute. Here is what actually happens on every vest. Your employer withholds federal tax at a flat 22%. That is the IRS default for supplemental wages under $1 million, written into IRS Publication 15 for 2026. Above $1 million, the mandatory rate jumps to 37%, but if your marginal federal rate is 32%, you're short 10 cents on every dollar of vested stock. If you're in the 37% top bracket, you're short 15 cents on every dollar. On $200,000 of RSU vests in a year, that is $20,000 to $30,000 in under-withheld tax every year, and it stacks and it compounds. If your modified adjusted gross income crosses $200,000 single or $250,000 married, you also owe the 3.8% net investment income tax on your investment income. Those thresholds have been frozen since 2013. They never adjust for inflation. So every year, more high-earning women quietly pay the NIIT, so NIT, without ever hearing the term. So why isn't anyone telling you this is happening? Your HR team is not a tax planner. They manage the equity program. And when you ask them about withholding, they'll provide you with the information as they understand it, that taxes are being withheld. However, they will not tell you the withholding rate is essentially a minimum, not a match for your actual tax rate. They don't know your specific tax bracket, and it is not their responsibility. Similarly, your equity platform, whether it's Fidelity, Schwab, or E-Trade, is not obligated to explain this to you either. Their role is to execute the vesting of shares and report the transactions. They will provide you with a 1099-B in January and consider their job done. And your CPA isn't going to proactively prevent this issue either. They're paid to file your tax return accurately. When they notice the shortfall in March, they will report it, attach the underpayment penalty, and move on. This process is simply tax filing, telling you in July that you are going to owe $24,000 next April and helping you address it in August. That is true tax planning. It's a separate job, and unfortunately for many women, this critical planning is often overlooked. So let me show you the 2 moves that diffuse it, starting with the one that stops the bleeding this year. Move 1, close the withholding gap. If you do not fix this, nothing else matters. The mistake is assuming your employer's withholding is good enough. It isn't. The 22% flat rate is a floor, not a match. And because your pay stub shows taxes coming out, your brain files it as handled. It is not handled. It is underhandled by design. You close the gap one of 3 ways, or a combination. Option A, bump your W-4. File a new W-4 with your employer and request additional federal withholding per paycheck. Simplest fix, shows up automatically every payday. Option B, quarterly estimated tax payments. You pay the IRS directly via Form 1040-ES on the 4 deadlines. This is the cleanest fix for big quarterly vest because you size each payment to the vest that just happened. Option C, sell to cover plus a supplemental sell. Most employers already sell a slice of each vest to cover the 22%, but you also sell an additional tranche to cover the gap between 22 and your actual marginal rate. The extra sale shows up as a short-term gain of essentially 0 because you're selling at the vest price. Here is an example. A VP at a biotech company has $280,000 in RSUs vesting across 4 quarters. Federal marginal rate, 35%. Her employer withholds the standard 22%, which is $61,600. Her actual federal liability on those vests is about $98,000. So the gap is $36,400. Add state tax and the NIT she had not budgeted for, and her April shortfall is roughly $48,000. We moved her onto quarterly estimates starting in Q2. When her return filed, she owed about $1,200, not $48,000. Same income, same vest, different structure. Move 2. Sell on vest unless there is a written reason not to. The mistake is treating each vest as a decision. The vest hits your brokerage, you look at the price, you think maybe it'll go up, and you hold. Multiply that by every vest over 3 years, and you've accidentally built a $500,000 concentrated position in the one company that also pays your salary. Paycheck and portfolio writing on the same employer. That is double exposure. Try this question. If someone handed you $280,000 in after-tax cash this year, would you use every single dollar to buy shares of your employer? Of course not. But by holding your vest, that is exactly what you're doing. You just never consciously made the decision. The rule. Sell on vest unless one of 3 written reasons applies. 1, you're in a trading blackout and legally cannot sell. 2, a tax-favored holding period genuinely applies and you are weeks from it. 3, you have a written concentration limit, say no more than 10% of my net worth in employer stock, and you're still under it. Otherwise, you sell on vest and diversify. The sale creates almost no gain because your basis is the vest price and you're selling immediately. One warning when you sell, the double tax trap. Brokerages sometimes report your cost basis as 0 on the 1099-B, leaving off the value you already paid tax on at vesting. If nobody catches it, you get taxed twice on the same money. Keep your vest records and make sure the basis on the 1099-B reflects the vest date value, not 0. This one line item quietly costs people thousands. The landing. The RSU tax mistake is 2 problems stacked on top of each other. The withholding gap, structural, fixable today, and the hold for patience trap, psychological, fixable with a written rule. Do both, and the surprise stops being a surprise. You know what you owe, you have already paid it, and your portfolio isn't riding on your employer. Do neither, you'll write a surprise check to the IRS every April for as long as you have equity compensation. And it gets bigger as your grants get bigger. Find your number today. Open your equity portal, find your year-to-date RSU vest total, and multiply by 0.13 if you are in the 35% bracket, or 0.15 if you are in the 37. That is the approximate check you are writing next April 15th if you change nothing between now and December. 10 minutes. Pick one of the 3 withholding fixes and start it this week. New W-4, quarterly estimated tax payment, or supplemental sell to cover, any one of them is dramatically better than doing nothing. Do not wait for your CPA to tell you in March. Write your sell on vest rule down, not in your head, on paper. Include the 3 exceptions. The next time a vest hits and your brain says, maybe it'll go up, you read the rule, not the price. If you want the 3rd piece to this, the multi-year bracket plan that connects your equity comp to your retirement, I'm covering that in the next video. Roth conversions in low-income years, donor-advised funds in high-income years, and the NIT and IRMA cliffs to watch for. The biggest piece of that is the Roth conversion window. I'll link it right here. Watch that next if you want the full picture. If you want everything I know about tax planning in one place, I put together a free retirement tax playbook. It walks you through the specific strategies, the timing decisions, and the mistakes that quietly cost high earners the most. The link is in the description. And if you want someone to run your actual vest schedule through this framework, your exact gap, your concentration risk, and your conversion windows, I offer a free Align call. The link is right there too. No pressure, no product sales. I'm a fee-only fiduciary financial planner. Whether we work together or not, you will walk away with clarity on your best next step. If you found this useful, the video I would send you to next is the Roth conversion window most high earners miss. It's a tax break that only opens for a few years in early retirement, and every year you miss is gone for good. Retirement is too important to wing. I'll see you in the next video.